Good morning, friends. Okay, let's today start with a new area. We're going to start with an area called as bond valuation. If you look at your security valuation, initial part was on share valuation. In between a part is there called as convertibles valuation, which I'll touch upon a little later once we are done with bond valuation. So today we're going to first discuss maybe for 30 minutes on what is the basis or what we are trying to do in bond valuation. In share valuation, we were trying to find out the fair price of a share, that is the price at which a share should quote. Share valuation also has multiple models of valuation, different approaches of valuation. You have different variants which impact, growth can impact, dividend can impact, earnings can impact, cost of equity can impact. Multiple things were impacting the value of a share. Value of a bond is also impacted by multiple parameters, but technically we have only one way of valuing the bond. I don't have multiple models. I have just one model of valuation, which is what I started in the first class when I started valuation. Value of any asset is what? I said something. Present value of future cash flows discounted at investors required rate of return, and that is the only approach of valuation we have for bond. So the only approach we are going to do is present value of future cash flows discounted at investors required rate of return. The only variant you may have is the something called as an irredeemable debt. Irredeemable debt is like a perpetual, there is no end to end irredeemable debt. So if it becomes a perpetual debt, you'll have to follow the formula of valuation of perpetuity. You'll have to follow the formula of valuation of perpetuity. That is also technically present value of future cash flows. That is also technically present value of future cash flows, just that the cash flows are there for 100 years, 200 years, 300 years. In Excel, I can do 100, 200, 300 years. You will not be in a position to do that. So that is where we had an approach called as valuation of a perpetuity. So bond valuation objective is to arrive at a fair value of a bond. Like shares are traded in the market, bonds are also traded in the market. So you want to know the fair price and then decide whether to buy a bond or not. Now, looking at the two asset classes, we had initially seen this equity, and I have an asset class called as debt. Equity is considered to be risky in nature. Equity is considered to be risky in nature. The reason for this being risky in nature is there's a lot of volatility in its performance. Sometimes it will go up, sometimes it will go down. Debt is considered to be less risky. Is there a risk element? Yes, there is a risk element, but it's considered to be less risky. Why is it considered to be less risky? Because if markets are going down, share prices will go down, but bond prices may not go down. The bond prices impact will not be there. So bond is considered to be less risky in nature as compared to equity, which is considered to be more risky in nature. If equity is more risky, debt is less risky, what is the impact of this on the discount rate? What will be the impact on the discount rate? This will have high cost of equity or high investors expectation, and debt is going to have low cost of debt or lower investor expectation. So from a cost angle, this is going to be high, this is going to be low. Equity doesn't have concept called as redeemability. There's no concept called not redeemable. I don't have redeemable concept as far as equity is concerned. Debt primarily in the practical world is redeemable in nature. Major chunk of the debt is going to be redeemable in nature. An example, 5-year fixed deposit. It is a redeemable debt of the bank. It is a redeemable debt of the bank. A 5-year fixed deposit which you create is a debt for the bank. So this is more of redeemable in nature. When it is redeemable in nature, there's going to be a life associated with it. They'll mention life information. Another angle which is more from a company point of view, whatever reward I give to an equity guy, I cannot claim any tax benefit on that. That is the dividends which I pay, no tax benefit. This is from a company point of view, okay? No tax benefit for a company, and here you will have a tax benefit. Earlier, what used to happen, this is earlier, whatever reward you are getting in debt, it was taxable from your point of view. That is the reward is basically the interest is taxable, and whatever reward an equity guy was getting, dividends, they were exempt earlier. Now both becomes taxable. This is from your point of view. That is, whenever you make an investment, taxability angle, when I see, your debt, whatever reward you are getting, taxable, and whatever reward you get for your equity is also taxable. One major factor which impacts the valuation of equity is the growth rate. Growth rate is a major factor which is going to impact the valuation of equity. So growth exists here, no concept of growth rate. There's no concept of growth rate in a debt. These are broad differences which I want to talk about. Now the only model I am going to use for valuation is present value of future cash flows discounted at investors required rate of return. If the investors required rate of return is given before tax, you will use the before tax cash flow. If they give after tax, which will happen in one or two question, you will use the after tax cash flow. After tax cash flow obviously depends on the marginal slab rate of the investor. The question would indicate about all that information. You may have a different tax rate for interest, different tax rate for capital gain. That can also be given in the question. Practical world, that does happen. Capital gain has a different tax rate, interest could have a different tax rate. So all that information could be given in the problem, and accordingly you will have to compute the cash flows and discount those cash flows. Whatever cash flows we are computing, we'll end up discounting those cash flows at the given rate. So value of a debt is the present value of future cash flows discounted at investors required rate of return. Now what are the factors which impact the valuation? First factor is face value of a bond. This does not have a major impact, but yes, higher the face value, more will be the value of the bond. Higher the face value, more is going to be the value of the bond, because higher the face value, more is going to be the interest. So the first factor is higher face value, higher the better. If the face value increases, technically you cannot increase face value and all. Basically a 10 rupee face value bond compared to 100 rupee face value bond, compared to a 1000 rupee face value bond, and compared to a 1 lakh rupee face value. So depending on the face value of the bond, you will see difference in valuation. Point number B is coupon rate. What is coupon rate? Is the rate which I am going to pay, the rate which the company is going to pay on the bond instrument. Whatever interest you are paying, that coupon rate will be applied on the face value. The coupon rate is going to be applied on the face value. So coupon rate, again higher the better, because what happens, higher means when coupon rate increases, my future cash flows increases, so the future cash flow will start going up if you increase the coupon rate. 10% vis-a-vis a 12%, vis-a-vis a 14%, vis-a-vis a 16%. But when coupon rate increases, normally what also happens in the practical world is discount rate will increase. When I say discount rate will increase, SBI does not give me a 10% interest, but an unknown company will give me a 10% interest. But when you do SBI valuation, if I ask you what is your required rate of return, you may say 6%. But when I ask you for an unknown company, you may tell me 10-11%. So one, the cash flow will increase, but the discount rate will also have an impact based on the coupon rate. Based on the coupon rate, when I say practical world, it is a known fact that if there is a higher coupon rate, it indirectly indicates, you will not see SBI giving a 10% interest. If SBI gives a 10% interest, you will see huge subscription to their bonds. You will see huge subscription, because everybody believes SBI to be risk free. Everybody believes SBI to be risk free. When you believe SBI to be risk free, you would not see them giving a coupon of 10%. Third factor is discount rate, lower the better. Discount rate is lower the better. What happens, we don't know. Lower the better, but if there you have a lower discount rate, it will have better valuation. It is going to have better valuation. Payment frequency. This may not have material impact, but yes, in our problem solving it may not have material impact, but in real world it has a huge impact. What is payment frequencies? If you create a fixed deposit with a bank, they'll say we are going to pay you interest every quarter. Somebody will say I don't want interest now. Then they'll say I'll do compounding quarterly, compounding monthly, compounding half yearly, compounding annually. If I pay you 12% once a year, and if I pay you 6% twice a year, mathematically 6% twice a year is effectively 12.36%. effectively 12.36. How 12.36 you have learnt earlier in time value of money at inter level. But compounding frequencies, if you have a shorter compounding frequency, your effective income starts going up. That is, instead of getting the money every year, if I can get the money every month, that is has higher benefit. Whenever you create a fixed deposit with a bank, if they are giving compounding interest, they'll say 8% compounded quarterly. In their advertisement itself, they'll say effective rate is 8.25%. They'll give an effective rate because your effective rate starts going up when you have a lower compounding frequency. Now, what is the end impact of this, which many people don't understand in a practical world? You take a home loan at 8%, you don't pay 8% because you pay interest every month. When you pay interest every month, the effective rate of a 8% home loan will be something like 8.5 or 9%. The effective rate will be 8.5 or 9% because it has compounding monthly. What is compounding frequencies? How frequently are you going to pay interest? Now, what happens if I have a 1 lakh rupee bond and 6% is the interest? If you pay every half year vis-a-vis every year I get 12,000. Every half year I'll get 6 and 6. The 6,000 which I get, I can create another fixed deposit. The 6,000 I can create another fixed deposit, earn interest on interest, earn interest on interest. That is what compounding frequency is all about. What is compounding frequencies? Earning interest on interest. So compounding frequency, lower the better. If you are shorter the better. Let's use the word shorter the better. If you can have lower compounding frequency, this will not have any impact on valuation when I do, because of one reason. There's something called as, whenever we do problems, we don't follow something called as an effective rate concept for simplicity's sake. So you will see that it may not have any major impact on the problems which we are going to do. But practical world, you give me two bonds, face value, assuming the price is same, which is a very rare scenario. Two bonds has a price in the market of 90. One bond has a face value of 80, another bond has a face value of 100. I'll select the 100 rupee bond. Face value higher the better. One bond gives 10% interest, another bond gives 12% interest. I'll choose the 12% interest. One bond has a discount rate which may not change because discount rate is your choice, but one bond has a discount rate of 7%, another bond has a discount rate of 9%. Lower the better. Payment frequency, one bond is paying interest every month, another bond is paying interest every quarter. I'll prefer the every month interest because it is always better if I have a shorter compounding frequency. These are major terms which is going to impact the bond valuation. Apart from this, there are types of bonds. Two major categories: redeemable and irredeemable. Redeemable and irredeemable. A redeemable bond is going to have a life. An irredeemable bond doesn't have any life associated with it. Now, for a redeemable bond, companies have different ways of issuing a redeemable bond. In a redeemable bond, a company may issue something called a zero coupon. What is zero coupon is there is no interest paid here. A zero coupon bond is one where we don't pay any interest. Why will someone invest it? Because a zero coupon bond is also called as deep discount bond. What is deep discount bond is? 1 lakh is the redeemable value. It will be issued at 3,000 rupees, 4,000 rupees, 5,000 rupees. So it is issued at deep discount. When you issue a deep discount, on the date of maturity, this 5,000 will become 1 lakh and you earn 95,000. So a zero coupon bond is preferred by people who don't want any regular income. They don't want any regular income. I'm earning at this stage. When I'm earning at this stage, I don't want any interest income. So I want to, normally when you create a fixed deposit, bank will give you two options saying that do you want a payout of the interest or do you want it to be reinvested. If you do a payout, it is called a coupon bond. If you do reinvest, tell them that I don't want this money, you give me on the last day. Technically, it is a zero coupon. Technically, it is a zero coupon because you're not going to get any money. You're not going to get any money. In a zero coupon bond, one amount would be paid today, one amount would be received on the maturity. One amount paid today, one amount is received on the maturity. Then we have something called as an annuity bond. What is an annuity bond is? Here 1 lakh rupee is what I invest. Every month interest, every year interest is paid. On the last day principal is paid. I tell them I don't want this concept of every year interest and all. You pay me one amount which is inclusive of interest and principal every year. Every year I want to. So you would have learnt about something called as equated annual installment calculation. in time value of money, or something called as an annuity amount. So if you are investing 1 lakh, it's a 8-year life, then there is some formula. Using that formula, you will say that the bond holder or the company will pay you 14,000 every year. This 14,000 includes interest as well as principal. Whenever you take a loan from a bank, if you take a home loan, they'll say every month you have to pay 10,000 rupees. That will include again interest and principal. So annuity bond is where you are going to get an equal interest, or interest plus principal put together. Initially interest will be high, principal will be low. As time passes by, your interest component will go down, principal component will start going up. But annuity bond has this characteristic. Then you have normal bond. Normal bond is where you will keep paying the amount, you will keep paying the amount, and on the redemption you will get the balance amount. On the redemption you're going to get the balance amount. So this is three categories you may see: a zero coupon bond which does not pay any interest, an annuity bond where interest and principal is equal, and a normal bond. In a normal bond, what happens is, you will be paying interest for 7-8 years, and then the principal is paid back. Another category I have in types is fixed versus variable bond. I'm not sure how much notes you want to make. You can keep making, but try to understand it. Some of them could be there in theory. Some of them I'm just trying to explain, which could be there in some or the other problem. What is fixed versus variable bond is? A fixed bond is one where the company will say we will pay 10%. A variable is basically a floating bond. What is floating bond is, when you take a loan from a bank, they'll say interest rate is RBI's rate plus 2%. RBI increases the rate, they'll also increase the rate. So like in a bond also, there can be a variable structure where today if interest rates go up, they will also start paying more. Today if interest rates go down, they will also start paying less. Normally what you see majority is fixed bonds. Majority you will see is fixed bond, but I can have a variable bond structure also. I can have a variable bond structure where I'm basically telling the investor that if interest rates go up in the economy, I'll pay you more. If interest rates go down in the economy, I'll pay you less. Normally bank loans work with a variable structure. But whenever a company is issuing a bond and when you subscribe to it, most of the times it's going to have a fixed structure. It will have a fixed structure. Then we have some two terms we use called as yield. Yield is basically return. Yield is nothing but return which you get out of a bond investment. Return which you are going to get out of a bond investment. In yield, I have two terms. I'll be explaining this with problems: current yield and yield to maturity. Yield is basically, in simple words, IRR of the instrument. Yield is basically IRR of the instrument. That is, whatever investments you are doing, somebody may want to know what is the return you are going to generate. When we did share valuation, predominantly problems were testing on getting the fair value. Here fair value will be there in 50% of the question, but 50% of the question would want us to know how much returns are we going to generate, which is technically called IRR, or yield to maturity. IRR, or technically yield to maturity. These are broad terms. I may have some more other terms in different question, but these are broad points which you need to know about a bond instrument. A bond instrument has most of the times a limited life, but you can also see a perpetual bond called as an irredeemable bond. It will have a face value along with a coupon rate. There's going to be a coupon rate which is going to be there. Discount rate depends on your expectation. In discount rate, I can have two types: pre-tax and post-tax. Pre-tax, if you have, you will use the cash flows pre-tax. Post-tax, if you have, you will use the cash flows to be post-tax, and accordingly do the discounting. Tax impact: taxes can reduce cost of debt. This is from a company point of view. And yield on debt, this is from your point of view. If somebody says I earn 6% from SBI FD, no, you're not earning 6%, you're earning only 4%, because 2% will go in the form of taxes. Depending on your marginal rate. Somebody may be in zero slab, for them it is 6%. For them it is 6%, but for somebody who is in 30% slab, effective rate will be only 4.2%. So the effective rate is going to, the return is going to increase or reduce based on the tax impact, and what also matters is in which slab you are in. Many a times you will see people saying that I'll try to create an FD in the name of a person in my family who's having lower income, or maybe I'll gift some money to my mother and I'll tell that you create an FD in your name. The reason is very simple. She is not in the taxation slab, so tax impact will not be there. I am in the tax slab, so I don't want to create an FD in my name. So tax also impacts your value which is going to be derived. Let me just see if at all any other major term I want to explain. Okay, I think broadly this should do. There are few more terms, but I cannot introduce now. There are concepts like duration, convexity, all that I can introduce later only, because you'll have to get some clarity first on what we do in bond valuation. Once that clarity emerges, I can then get to a stage of introducing those additional points. Any doubts till this? Any doubts on the base which I've created? Just try to be very clear on this base, because this is what is going to help us in doing the valuation. Now the next part is what we need to do is, for doing bond valuation, I need to basically derive year, cash flows, PVF at some rate, and DCF. This is for a redeemable bond. For a redeemable bond, okay, one more thing, sorry, I missed out. Uh, a bond can be issued at par, premium, discount. If at all any restrictions are there in Companies Act, let me know, but I don't remember anything being there. But if it's there, it can be issued at par, premium, or discount. If for example, if at all there are restrictions, let's not worry about it, because we learn FM from global context. So global context, it can be issued at par, premium, or discount. If problem is silent, the issue will happen at par. If problem is silent, the issue will happen at par. Similarly, bond can be issued or redeemed, both scenario. Issued or redeemed at par, premium, or discount. Problem silent, both will happen at par. Wherever problem is silent, it is going to happen at par. Problem tells you some information, please follow that. Problem will say they may give information on issue but not redemption. They may give information on redemption but not issue. So whatever information is available, factor that information and then proceed ahead. So a bond can be issued at par, or premium, or discount. Issued at par, premium, sorry, redeemed at par, premium, or discount. Let's take an example of a redeemable bond. PVF for 10%. 10% is basically investor's expectation. An investor is saying, I want a return of 10%. It's a 5-year bond. Company is paying 10 rupees interest. Company is paying 10 rupees interest. On maturity, it is getting redeemed at par. 5 can be clubbed together and written as 110 also. You can write it as 110 also, or you want to write it as two separate. This 100 is technically the perpetuity part. It's technically like the perpetuity part, where the company is saying, you don't think about future years. I'm redeeming it and giving you the money. I'm redeeming it and giving you the money. I want to discount this at 10%. I'm not doing any rounding off in this calculation. You will see that company is paying 10%. Company is paying 10%. What is investor expecting? 10%. PVF at 10%. Very important concept. Company is paying 10%. Investor is expecting 10%. And the redemption is happening at par. Everything is happening at par. If you meet investors expectation, if you meet means exactly meeting, then the bond will quote at par value. The bond will quote at par value. If you are meeting expectation of the investor, bondholders will say, I'll pay you the par value. I'll pay you the par value. If you exceed expectation, how can you exceed? By paying 12. by paying 12 because bondholders want only 10. If you exceed expectation, it will quote at premium. If you exceed expectation, it is going to quote at premium. All this calculation assumes that redemption is going to happen at par. Redemption suddenly happens at some other thing, that is also exceeding expectation. So that is a separate calculation. So I'm just talking about the base interest. I'm talking about the base interest with an understanding that the redemption is going to happen at par. If you exceed expectation, it will quote at premium. If you're exceeding expectation, it will quote at premium. And if you are not able to meet the expectation, if you're not able to meet the expectation, it will quote at discount. It has to quote at discount. So for example, suddenly you want to do 14%. Company is paying 12% and you want to do at 14%. It will quote at discount. It is going to quote at discount 93. It is going to quote at discount. So the end conclusion is assuming redemption happens at par. I'm issue price. I'm not talking about redemption happens at par because what you are calculating is issue price. What you are trying to do is fair value. What is fair value? Likely issue price. Likely issue price. So bond interest equal to investor expectation. Bond interest equal to investor expectation. Bond will quote at par. Bond will quote at par. Bond interest greater than investor expectation. Greater means you're exceeding. Greater than investor expectation. Bond will quote at premium. Bond will quote at premium. If you are equating, it will quote at par. If you are exceeding, the expectation, it is going to quote at premium. And in case you are not able to meet the expectation, this point alone you may write. It will be there in my discussion, but this is slightly an important point. It will be there in somewhere in the discussion, but you may write this. So if you are meeting par value, if you are exceeding premium, and if you are not meeting, if you are having a shortfall, it has to quote at discount. It has to quote at discount. Clear? Any doubts on this? As with the assumption that redemption is happening at par. Okay, redemption happens at premium, you cannot make this equation because then there are two angle. What are two angle? One, are you meeting interest expectation or not? Because redemption expectation is exceeding whenever it happens at premium. So I'll have to club 2 points together. Finally, will it be par, premium, discount? I cannot give an answer. So assuming the redemption is happening at par, these are three equations. Now why this is critical is, you will see suddenly a problem. The company will say calculate yield to maturity and they'll say the bond is quoting at par. Student will try to do all the calculation. No need to do, because what is YTM or what is investors expectation is very simple. If bond is quoting at par, investors expectation is equal to the coupon rate which the company is paying, equal to coupon rate. There are problems where this is tested, because what happens is, it used to be a lengthy 10-mark question. There are 5-6 extra concepts which are there. A student is spending, you will spend some 4-5 minutes on YTM calculation. That's of no use. Once you know this, that it is quoting at par, redemption is also happening at par, the YTM or investors expectation, YTM is called investors expectation, is equal to the interest which is being paid on the bond, is equal to the interest which is being paid on the bond. This is a broad understanding I want to give. I'll be starting with problem solving. I may introduce here, I may not introduce that many new concepts. Some are there, some new concept I may introduce, but broadly I've discussed. Broad points which I told you is, the value of the bond depends on face value, higher the better. Coupon rate, again higher the better. Discount rate, that is which is your investors expectation. Payment frequency, it can have impact based on the payment frequency from a practical world point of view. When you do in problem solving, you may not see material impact. Types of bond, there can be a redeemable bond or an irredeemable bond. In redeemable, I can have zero coupon, I can have an annuity bond, I can have a normal bond. I can also have fixed versus a variable bond structure. In fact, there's another thing called as convertible and non-convertible. Convertible, I'll be discussing in the earlier segment when I said after share valuation, if you see your material, the next segment is convertible instrument. I'm not doing that. I've moved to the next segment, which is your bond valuation. I'll be going back to convertible. So in a type of bond, you can also say one other type called as convertible versus non-convertible. Or in fact, convertible is a subset of redeemable. Convertible is a subset of your redeemable bond, because any bond which is redeemable can only have an option of conversion. Irredeemable bond may not have that option of conversion. So there's another category called as convertible bond. There can be a category called as convertible bond. Then yield, you have two types of yield. One is called current yield and yield to maturity. Taxes will reduce the cost of debt. Similarly, it will reduce your yield on debt. Whatever you are earning will also go down. Whatever company paying is also going down. Bond can be issued at par, premium, discount. Similarly, your redemption can also happen at par, premium, or discount. And based on cash flows, I have three equation. If bond is meeting expectation, it will happen at par, issue will happen at par. Exceeding expectation, bond will quote at premium. Not meeting the expectation, bond will quote at discount. Any doubts on this? Anywhere, anything you want me to explain related to bond, let me know. I've just tried doing a base understanding. Most of this you may be aware, most of this you may be aware, but just to recap what happens in a bond instrument, we are trying to, when I say bond instrument, it's not only a bond, you can even use technically a fixed deposit valuation also. We normally use bond, but the term is debt valuation. Debt means it can be a bond, it can be a fixed deposit, it can be anything. There's also a segment of debt called a short-term debt instrument. What is short-term is less than 1 year, which you will learn in this chapter only, but part of money market instrument. There's something called as money market instrument, which is another segment of security valuation. So anything less than a year, normally I'm not getting into this. There's another angle called as money market instrument way of valuation. We'll see it there. Mostly more than a year, sometimes less than a year can also be there, but mostly more than a year is what you're going to analyze. So part 4 is convertible, which we'll see it later. Part 5 of the chapter, I come to bond valuation, question 61. Bond valuation, question 61. Go through the question, I'll explain and then we start doing it. Okay, I'll start doing it. Nominal value of a 10% bond issued by a company is rupees 100. Bonds are redeemable at 110 at the end of year 5. Determine the value of the bond if required yield. Required yield is 5%, 10%. What will be the price at the end of each of the next 5 years in case the required yield is 5%? So totally there are three parts to the question. First is this 10% is called what? This is the coupon rate. 100 is face value or nominal value, redeemable at 110. So I cannot say 10% is investor expectation, 10% is company paying, bond will quote at par. All that will not work because your redemption is happening at 110. Redemption is happening at 110, which is at a premium. Determine the value of the bond if required yield. Required yield is investors expectation, 5% and 10%. 5 and 10 is basically the discount rate. Is basically the discount rate, which is today's valuation. Then they're saying what should be the value at the end of first year, second year, third year, fourth year, fifth year. They want the value for each of the next 5 years. They want the value for each of the next 5 years. What to do, I'll explain in some time. Let's start. Valuation of bond. Valuation of bond. I'll write some basic information. I don't need this basic information from an exam point of view or for every problem, but I want your mind to think on all these things. So I'm giving a structure. So every problem you do, please think on these terms. If you think on these terms, you will go to the right route. So basic information. Point number one, coupon rate. Coupon rate. Tell me the coupon rate of the bond. 10%. Face value. Tax rate. If not given, let's ignore it. That's all. Tax rate, if not given, doesn't matter. If it's given, you'll see very rare problem tax rate being there. But I just want to create a structure so that your mind starts thinking on these things. Tax rate, not given. Life, how many years is the life of the bond? 5 years. Redeemable value, how much? 110. Payment frequency. This is going to be very critical in few questions, but the approach is slightly wrong, but that's what we have been doing because it's just a shortcut way of doing. That's what ICA has been doing. Approximate answer is what you will get for based on payment frequency. Is there any payment frequency given in the question? Half yearly, quarterly, monthly? Nothing is given, so then annual. Payment frequency is annual. Every year interest would be paid. Payment frequency is annual. Discount rate. You can use the word discount rate. You can use the word investor expectation. You can use the word required yield. Different names could be there in the question. Discount rate, investors expectation, required yield, uh, a comparable bonds interest. Basically, like in cost of equity, we had opportunity cost of capital, investors required rate of return. So multiple names were there. Yield on a comparable company. So like that, you can have here also. What is the discount rate they mentioned? 5%. 5 and 10%. Let's first do the 5% part. Okay, let me write 5 and 10%. I'll not create a basic structure again. 5 and 10%. This basic structure, if you think through, again I'm repeating, not mandatory. Does it add a lot of value? It doesn't add much of value because in my solution you may not see this basic information, but I want your mind to think on all these things. That's all. So let's create now year cash flow PVF DCF. Year cash flow PVF at 5%, DCF. Some question will ask you to calculate IRR. If IRR is asked, you start with year 0, else we start with year 1 and write the cash flow. So year 1 to 5 together, it's an annuity. What is annuity? Is interest. The interest is same. It's not an annuity bond per se, but interest is going to be same. 1 to 5 and year 5. How much interest the bond is going to pay? 10. 1 to 5, 10 rupees you will receive. At the end of year 5, extra how much? 1, not 100 plus 10. Okay, sorry, 110. 110 is the redeemable value. 110 is the redeemable value. The interest of 50 year is already written above. Okay, the interest of the 50 year is already captured above. This 110 is only the redeemable value. We normally do it in perpetual. We normally use the annuity factor to save time. Get the 5 year annuity factor. 1 divided by 1.05. I hope you are clear on how to calculate annuity factor. 1 divided by 1.05 equal to, again equal to will give you second year, equal to third year, equal to fourth year, equal to fifth year, GT. GT will give you the 5 year factor. Or 1 divided by 1.05 equal to M plus, equal to M plus, and then you do an MRC. I hope that's clear. Still, if somebody has a doubt, let me know. 1 divided by 1.05 equal to first year, equal to second year, equal to third year, equal to fourth year, equal to fifth year. Before you press the GT button, write the fifth year factor here. Before you press the GT button, I would want the fifth year factor to be written and then press a GT button so that you get the annuity also. So tell me the fifth year factor first. 0.784, 0.784, and tell me the 5 year annuity factor. 4.329. Be very clear. Don't try to make, because when you do rounding off in the third decimal, ensure that you do proper rounding off. More than 5, higher number, less than 5, all that please take care. DCF you do, and this is the value of the bond. 129.53. Fair value of bond. Fair value of bond 129.53. The fair value of the bond is 129.53. Any doubts on this? Repeat the same calculation, 10%. Repeat the same computation. PVF at 10%. Cash flows are going to remain same. If the redemption was to happen at 100, no, then PVF at 10% is not required to be calculated. Directly answer is 100. Directly answer is going to be 100. The reason is very simple, because it's meeting expectation. It is meeting expectation. It will quote at par value. It will quote at par. One divided by 1.1 equal to, you keep doing. Tell me the fifth year factor and the 5-year annuity factor. Fifth year factor is 0.621. 5-year factor 791. Okay, 3.791. Value is 106.22. Value is 106.22. Any doubts on this? Kind of a straightforward, simple calculation. Clear? Now, the next part of the question is asking, what will be the price of the bond at the end of each of the next 5 years if the required yield is 5%? So, we are going to work with 5%. They don't want us to do both the scenario. So, if I take 5%, today's price is 129.53. Year 0 price 129.53. Then I'll need a year 1 price, year 2 price, year 3 price. Assuming 1 year got over. I'll first explain the detailed approach, then I'll give a shortcut approach. Listen for some time. Assume 1 year is over. So you are past 1 year. This will now become a 4-year bond. This will now become a 4-year bond. 1 year is over. It will now become a 4-year bond, assuming 1 year is over. That's how you'll have to imagine and do the valuation. So you are going forward by 1 year. So now the number of years is 1 to 4. The number of years is 1 to 4, which is technically earlier was 2 to 5. That 1 to 4 is now, the earlier 2 to 5 has now become 1 to 4. 1 year is over. That is over. Interest paid, everything is gone. So 1 to 4, I need the annuity factor. 4th year, I need the factor, and I'll get the answer. 1 to 4, I need the annuity factor, and I need the 4th year factor. I don't want you to do wait for some time. Tell me the 4-year annuity factor. Tell me the 4-year annuity factor. 3.546. Answer is 125.99. 3.546. Answer will become, year 1 price is 125.99. That is, I did the calculation assuming 1 year forward. I have gone 1 year forward. Then at the end of second year, 2 years over. At the end of second year is 2 years over. So you have only 1, 2, 3 and year 3. 1, 2, 3 and year 3. Tell me a 3-year annuity factor. 2.71. 723. Okay, 2.723. 122.27. Like this, it'll keep going on. It'll keep going on. This is a longer approach. This is a longer approach, but I wanted to show this approach because some problem you'll find it difficult to understand what needs to be done. Then the longer approach will only help you. So longer approach is very simple. Present value of future cash flows, assuming 1 year is over. Assuming the year has got over, imagine the cash flow, put it. Another year is over, imagine the cash flow, do the calculation. Another year over, imagine the cash flow, do the calculation. Now, instead of doing this longer route, I am going to use Modigliani-Miller approach, which I told you earlier, which I said year 1 price is equal to year 0 price plus, I need something extra. What is something extra? 5%. Year 0 price plus 5%. In this, I am going to deduct what I get in the first year. I'm going to deduct what I get in the first year. If you remember, when I did in share valuation, I said P1 is equal to P0 into 1 plus KE. P0 into 1 plus KE. I can say the same thing here. Year 1 price is equal to P0 into 1 plus KD. KD is cost of debt or investors expectation minus dividend of year 1 minus interest of year 1 minus interest of year 1. Logic is very simple. Today price is 129.53. What I'm telling the companies, give me extra 5% by the end of the year. So 129.53 should ideally go up to 136. Should ideally go up to 136. Now company is saying, why you want 136? I'm giving you 10 rupees interest. I'm giving you 10 rupees interest. I'm saying I'm very happy you give me 10 rupees interest and extra 126 as the price. Extra 126 as the price, because my expectation is very clear. I want only one thing. I want 129.53 to go up by 5% because I want return. How do I want return? My return expectation is this into 5%. Now in the 6.47, company will pay 10 rupees. Balance what will happen is price reduction. Balance is price reduction because you wanted only 6 rupees 47 paise. Company is saying I'll pay you 10 rupees interest. I'll pay you 10 rupees interest. So there is going to be a price reduction of 3.52, which will translate into 126, and which is what you got here. Fair value of bond by doing discounting of a 4-year bond. By discounting of a 4-year bond. I'll repeat. One approach is calculating a 4-year valuation, 3-year valuation, 2-year valuation, 1-year valuation, year 0 valuation. Longer route will take time. Longer route, it is going to take time, because if they ask me to calculate end of each of the years, I can't do this. When I did share valuation, if you remember, in one place we touched upon this, there was a problem where I wanted to maintain the dividend income. So where what I wanted is, I wanted year 0 price, year 1 price, year 2 price, year 3 price. So we reverse worked and did discounting. I could have moved forward and done compounding also. Simple logic I have is, today if I pay 100 rupees, if I want 5% return, by the end of the year 100 should become 105. I have only one thing in my mind. This 105 can go down if you are paying me some interest. Can go down if you are paying me some interest. Don't get into any formula and all, but be very clear on the logic. Every time if you are clear on the logic, you will find it easy to do in exam. Else you will have to keep remembering the formula. Till now, at least except for one area, maybe that H model alone, there also I try to explain logic, but that's one place maybe I would want you to revise the formula. But other place I don't expect you to do anything on the formula front. Till now, nothing on the formula front. In bond valuation, one or two areas, maybe one area alone, and convexity area, I may tell you to remember the formula. I'll explain the logic, but still it's a very lengthy formula, so you may have to remember it. But otherwise, our approach is get out of the formula route, be more on the logic front. So 125.1 not sorry, whatever was the price, 129.53 is today's price. This has to go up by 5%, reduce by interest. Again go up by 5%, reduce 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 interest. When you reach year 5, the value will be 110. The value will be 110, which the company will pay you and the bond will get closed. The company will pay you that 110 and the bond will get closed. Any doubts on this? I'm not going to do the longer route. Longer route is something you, if you have understood, you may do it in some problem later on, but be clear on the longer route. Longer route is assuming 1 year is passed by, assuming 2 years is passed by, assuming 3 years is passed by, assuming 4 years is passed by, assuming 5 years is passed by. Any doubts on the approach? Valuation of bond at the end of each of the 5 years. Valuation of bond at the end of each of the 5 years. At the end of each of the 5 years, particulars and amount. Particulars and amount. Fair price on day 0. Fair price on day 0 was a fair price on day 0. You calculated it. 129.53. Add required yield. Add required yield of year 1. Required yield of year 1. What is required yield of year 1 is, in this 129.53, I want 5%. In this 129.53, I need 5%. My expectations are very clear. I need 5% on this 129.53. Less interest paid. Company is saying, we cannot give you extra 5% and all. We are paying you some money. We are paying you interest paid in year 1. Less interest paid in year 1. Now in practical world, what also happens is, you may have come across this earlier also. If you start with this 129 year 0, as days passes by, your bond value will keep going up because a concept called as accrued interest, because on the bond the interest keeps getting accrued. Today it will be at 129, in 1 month it will touch 130, then 131, 132, 133. The value will keep going up because when you invest today you will get 12 months interest. Invest after 10 months, let's assume, you'll still get 12 months interest paid by the bond. You'll still get 12 months interest paid by the bond, which is not right, so that is why what normally happens is the bond price will keep going up every day. It'll keep going up every day, because assume I invest in a bond today and I move out of the bond in 11th month because of some reason, I will earn zero if this price movement is not happening. And somebody who invests in 11th month will earn the entire interest. Market is not going to allow that. Market is not going to allow. So normally what will happen is this price will keep going up like this. Interest paid, it will crash down. Again will start going up, interest paid go down, again start going up. This is x interest come interest valuation. So as it goes up it becomes come interest value, moment it drops it becomes x interest. As it goes up, come interest comes down, x interest goes up, comes down. So this will keep happening. That going up is basically because of extra accrued interest. So the investment can quote at x interest or come interest. You would have learned this in investment accounting. So x interest and come interest kind of a valuation. Moment interest is paid, it goes down. The fair price or the base cost price is always a straight line, is always a straight line unless some changes happen in the bond. What can change happen? The investors expectation can change, market changes are happening, so company suddenly having a risk of default, all that is fine. But otherwise if nothing changes, no risk change, the base price will always be a straight line. Extra accrued interest will keep getting added, extra accrued interest will keep getting added and will suddenly fall, will keep getting added, suddenly fall, keep getting added, suddenly fall. In this case the base price is not going to be a straight line. The reason is 5 and 10%. There is a deviation of 5% which the investor wants and 10% which the company is giving. But otherwise the base price will be a straight line, and accrued interest, x interest, accrued interest, x interest, it will keep happening. So here moment interest is paid, moment interest is paid, you will get the price of fair price of year 1, fair price of year 1. Moment interest is paid, it will go down to 126.01, it will go down to 126.01, fair price of year 1. Same answer I could have got by doing a lengthier valuation exercise. We could have done a lengthier valuation, we would have got the same answer. Again add required yield of year 2. Now this is on required yield of year 2 on 126. I need this into 5% on 126 because that's the price I will be having or somebody who invests will have. 5% on this, less interest year 2, interest paid in year 2, less interest paid in year 2, fair price of year 2. You can keep doing it. Add required yield of year 3, less interest paid of year 3. Add required yield of year 4, less interest paid. Add required yield, less interest. Keep doing it. Last year you will see the fair price to be 110. Up and down rounding of difference can be there, there can be some rounding of gap. Keep doing it. You can check the screen in case you need, but otherwise keep doing it. It will go up by 5% because that's the investor's expectation. Interest payout will reduce, the interest payout part will decline. year 2 fair price, year 3 fair price, year 4 fair price, year 5 fair price. I should ideally get exact 110. The gap is rounding off difference. Any doubts on this? And this is one, okay, first complete it. 126, 122, 118, 114, and 110. It's 110.07. Ideally, we would have got 110. That's the redeemable value. That's the redeemable value. This approach which I did can be used for any asset. You want to value this building also, you can do it. The building also can be valued using this. Today's value is 2 crore. Add 10% extra, I want 2 crore 20. Rental income of the first year is going to be 20 lakhs, 30 lakhs, 40 lakhs, whatever number you get. You subtract that and get the fair value of the property at the end of year 1. Add again the return which you need, deduct the rental income. Add return, deduct the rental income. So now what we have indirectly ended up doing here is, there are certain asset classes which don't pay anything. When you don't pay anything, I basically want this extra. When you are paying me something, so this is basically the expected growth. I want this price to grow by 5%. But company is saying no, it won't grow by 5% because I'm going to pay you something. I'm going to pay you something. So let's deduct that and then you get the balance price. Any doubts on this? Any doubts on this computation? Now, this is also one reason if you start with 100, when will you start with 100? 10% is equal to 10%. Company wants 10%, investor gives, company gives 10%, investor also wants 10%. 100 add 10%, 10, deduct 10 rupees. Again 100, add 10%, 10 rupees, deduct 10 rupees. So this will always quote at 100 in case you are meeting the expectation, provided that redemption is not, because if redemption is happening at 110, then this will start quoting at premium. This will start quoting at premium because redemption is happening at premium. But that's a different thing. But basic logic is this. This is the logic you should be aware of. You can go through the solution. Let me know if there's any doubt on this question before I proceed to the next one. Any doubts anywhere in this? Any concept related doubt if you have, please let me know. What is the IRR for? IRR is whatever is the discount rate you're using. Hmm. Any doubts on this? Clear? Can we proceed? Done. 62 is homework. Let's come to 63. This got tested in exam. I'll be discussing the question. Mr. X wants to invest 1 lakh in a 7-year 8% bond in the market, face value rupees 100, which were issued 2 years ago. You are requested to advise him what is the maximum price for bonds to be paid in the following scenario. Mr. X is expecting minimum 9% return, minimum 7% return. Present rate of similar bond is 8.25, similar bond is 7.75. Bonds are available at par, 1% is the transaction cost. What is the effective yield? Find the number of days required to break even transaction cost if the bonds are available at par, and 2% is the transaction cost. Important part is this discussion. The earlier part is fairly simple. Just go through the question. Hmm. Cost of equity calculation. So it's only D1 by P naught. Only D1 by P naught. So it's not D1, it's called I1 interest. But provided that's an irredeemable debt, you will learn about this in some time. Okay, I want to invest 1 lakh rupee. Doesn't really matter for us this 1 lakh rupee part, because I'm going to value one bond. I can multiply with the number of bonds if I want to write the final answer. It is a 7-year bond paying 8% interest. It's a 7-year bond paying 8% interest, which were issued 2 years ago, Now this 2 years ago is very critical, because when I do my cash flow calculation, I'll do cash flow calculation for how many years? 5 years, because the bond was issued 2 years ago. So 2 years is over, and today we are doing the valuation. If I had the base price, I could have used shortcut, because that and all they'll not give now, because last problem what we did, we had the base price 1 year forward, 2 year forward, 3 year forward, 4 year forward, 5 year forward, we did the calculation. Now in this question, 2 years have already gone by, let's ignore whatever gone by. Balance years, I'll put the cash flow. Expecting 9% return, there's a discount rate. 7% return, discount rate. Present rate of similar bond is proxy company 8.25. We did one problem on proxy company valuation in equity, and we did two adjustments. Some conditions where they're saying that capital gearing ratio condition, interest coverage ratio. Similarly here bond also you can do. I'll say SBI is giving 7% interest. So I cannot apply 7% discount rate for an yes bank. Reason is, I'll put condition. SBI has condition 1, gross NPA of 5%. Condition 2, for a banking industry, what are the critical ratios? One is gross NPA, second is net interest income which they are going to earn, third is capital adequacy ratio, saying that these are the ratios. You calculate the ratios and then alter the risk. If we want, I can change it like this also. I can say present rate of similar bond is 8.25. However, the similar bond is slightly less riskier. I just leave it like that. Then you will have to use a discount rate slightly more than 8.25. Now what is more? Assumption. What number you want to take? It will be assumption. So be very clear on the logic. The discount rate which we use depends on the risk. Like you calculate beta for an equity share, you can also calculate beta for a debt instrument. You will learn about this when we do go to portfolio. So I can also use for cost of debt RF plus debt beta into RM minus RF plus debt beta into RM minus RF. That's a formula which we can use to calculate the discount rate. So I have four discount rates in this question: 9%, 7%, 8.2, 7.75. You may do it in two working notes or in one working note. If you do in one working note, year cash flow is common. PVF at 9 DCF, PVF at 7 DCF, PVF at 8.25 DCF, PVF at 7.75 in DCF. If you can open 10 columns, we'll do one working note. Else 6 columns and again 6 columns. What is 6 columns? Again 6 is year and cash flow will have to be repeated. You will have to repeat the year and cash flow. I'm doing it in single column, single table. Depending on the space you have, you can decide. Working note 1, valuation of bond. Any doubts in the question? The other parts I'll explain in some time. Any doubts in the question? It is issued 2 years ago, which means balance life is 5 years. Balance life is 5 years. So we will do cash flow only for the 5-year period. Year cash flow, PVF at 9% DCF, PVF at 7% DCF, PVF at 8.25% and DCF, PVF at 7.75% and DCF. Year cash flow, PVF, DCF. Multiple rates are there: 9%, 7%, 8.25% and 7.75%. Whenever I ask you bond life, you should always think about balance life of the bond. What has gone by is no use. So how much is the bond's life here? So 1 to 5, year 5, 1 to 5 and year 5, What is the interest rate on the bond? 8%. Face value is, so 8 rupees. 8 rupees is interest. Anything mentioned about redemption? At par. Redemption will happen at par. Before you start doing calculation, only thing I can tell you is this will quote at premium 9% part, this will quote at discount, this will quote at premium. Sorry, opposite 9% discount rate, it will quote at discount because you are not meeting the expectation. When you don't meet the expectation, it will quote at discount. This thing should be very clear to you because this can get tested in an MCQ. It can get tested in a MCQ where you do all this lengthy calculation. No use of doing any lengthy calculation. They'll give you a scenario and they'll give you three options: discount, premium, or par. You do all this lengthy calculations, of no use. You can directly get to the answer. So company is paying 8%, investor want 9% discount, investor want 7% premium, investor want 8.25% discount, 7.75% premium. Get the answers. I'm not doing anything here. Please start doing it. Discounting at these four rates. One divided by 1.09. There's no major concept here. The next part of the question I want to spend a little bit of time, but this part is fairly simple. Clear? Can we proceed? Any doubts on this? So as discount rate goes up, you start with 7, which is the lowest discount rate. As it goes up, price will start crashing. 104 became 101, then became 99, then became 96. As we increase from 7 to 7.75 to 8.25 to 9, as you increase the discount rate, you will see reduction in the valuation of the company. Any doubts on this? Any doubts on this calculation? Can we proceed? Now, the problem is saying if the bonds are available at par, 1% is the transaction cost. What is the effective yield? What is the effective yield? There are multiple ways of calculating this. I'll explain what ICI has ended up doing and which is also logical. Their approach is also logical. I can also go through an IRR route. Bonds are available at par. Bonds are available at par, which means yield, you can write in some time, equal to coupon rate. Yield is equal to coupon rate. What is yield? Is basically the return. Yield is basically the return. So coupon rate is 8%. But the problem is there is a transaction cost. Now this 8% I earn every year. Transaction cost is one time. Transaction cost is only one time. So I cannot say 8 minus 1% and make it 7%. That's not logical because transaction cost is not incurred every time. Another approach is to go through an IRR route. What is IRR route? Is day 0 101 I pay. What is 101? 100 plus 1% transaction cost. Every year I get 8. In maturity I get 108. Try to do an IRR based approach which can give you an answer, which is a longer way of doing, which will also give a slightly different answer, which will slightly give a different answer. What ICI did is they started with 8. 8 on a base of 100 is 8%. 8 on a base of 100 is 8%. That is bond is paying 8 rupees and it is quoting at par, but you are required to pay 101. You are required to pay 101. You are not going to pay 8. You are going to pay 101. Can you tell me what percentage is this? 7 point. So what they did is they said whatever you are paying, not even 8 divided by 101. They said, which is to me, see many places we do only approximate calculation in bond valuation. So approximate calculation is bond yield into 1 minus transaction cost. This is a formula you will learn about post-tax return. Post-tax return is pre-tax return into 1 minus tax rate into 1 minus tax rate. So here what the formula they wanted us to use is bond yield into 1 minus this transaction cost. 1 minus the transaction cost. This will end up giving you 7.92. Wait for a minute. If you go through IRR route, that is if you invest 100, let's assume 8, 8, 8 and 108. This is provided no transaction cost is there. IRR will be equal to 8%. But in case you pay transaction cost and make it 101, it's not going to be 7.92. It's not going to be 7.92. It is going to be slightly lesser than that, which is 7.75. Which is 7.75. If you do 101, this also assuming the life increases and you are giving 888, then it is 7.86. As life goes up, because this 1% is distributed over 5 years now, then 1% will get distributed over 10 years, then 15 years, then 20 years, then 25 years. So as life goes up, the effect of this 1% will keep going down. The effect of this 1% will keep going down. An approximate answer is 7.92. An exact answer which ICI did not present and which is okay because we are just trying to do it in a shortcut way. If you want exact answer, it is 7.75%. Yield is basically what I'm going to earn. Yield is basically what I'm going to earn. Can I get 7.75 using some formula? No, it can't work through formula. You'll have to do IRR route. One positive NPV, one negative NPV, and then get to the calculation. Broadly, in this question, I could have told that with seeing this number. Because if it's 101 is what I'm going to pay, technically, when I do discounting, I'll get it at 7.75. I'll get it at 7.75. But again, that's not needed in exam. Simple logic is transaction cost is one-time expense which we are going to pay. So whatever return we are going to earn, just remove the effect of the transaction cost. Remove the effect of the transaction cost. Clear? Any doubts on this? The ideal formula according to me is 8 by 101. 8 by 101, which is technically called as current yield, which is technically called as current yield. I'll be touching upon that later on. I'll be touching upon concept called as current yield later on. But an ideal or logical formula could have been 8 divided by 101. Whatever transaction cost we are going to pay, it is going to reduce our yield. That's one point. The second point is if it's quoting at par, your coupon rate is equal to the investor's yield. So the gross yield is 8%, net yield is 8, not minus 1%, 8 into 1 minus 1%, 8 into 1. If you directly deduct 1%, you are assuming 1% is going to be there every year, which is not right. Clear? Any doubts on this? Let's start. Can be. I have no idea whether it is there for selling or not. I have no idea as of now. So it can be there. Basically, return is what is return calculation is what you get divided by what you invest. That's a simple formula. What I get 8 rupees. What I invest 101 rupee. So if it's there for the maturity, then in this calculation it will further get impacted. It will become 107 because on maturity you will get only 99. You will see this going down to further 7.58. It can further go down. Can be there for both also. I have no idea. I'm not getting into it. Uh, let's write first. Bond is quoting at par. Bond is quoting at par. Bond is quoting at par, and this would mean this would mean this would mean bond yield bond yield is equal to, this would mean bond yield is equal to coupon rate. Bond yield is equal to coupon rate. Bond yield before transaction cost. Before transaction cost is equal to coupon rate equal to 8%. Equal to 8%. Net bond yield is equal to, net bond yield is equal to 8% into 1 minus transaction cost. Assuming this is a 1 year bond, if at all it's a 1 year bond, it's directly 8 minus 1%. It's directly 8 minus 1% because you earn 8% for 1 year, 1% also you pay once, directly subtract 1%. If it's included on both sale and purchase, then 8 minus 1 minus 1 because 2% will go in this. If it's a one-time expense and 1 year interest, if it is just a 1 year interest, 8 into 1 minus 1%, 7.92. Any doubts on this? Clear? Can you proceed? Next, they are asking, find the number of days required to break even transaction cost if the bonds are available at par and 2% is the transaction cost. Now, what they are trying to ask here is, I'm going to pay 2% as transaction cost. You bought the bond today. In 10 days, you sell it. In 10 days, you sell it. Your interest income which you're going to get may not even recover the transaction cost, may not even recover the transaction cost. 100 rupees is the bond value. 2 rupees you will pay as transaction cost. If you are staying for only 1 month, for staying for 1 month, the interest for 1 month is 8 rupees into 1 by 12, which is only 67 paise. So if you're staying only for 1 month, you will not even recover the transaction cost. You will not even recover the transaction cost. Break even transaction cost is, our number of days to break even is basically simple. It is basically number of days break even transaction cost is, in how many days can I earn interest income of 2 rupees? In how many days can I earn interest income of 2 rupees so that I'm able to recover the transaction cost? So that I'm able to recover the transaction cost. Anything beyond that will only start becoming profits for me. Anything beyond that. So whenever you invest in a debt instrument or wherever there are transaction costs, there is some minimum period you will have to wait. You cannot keep doing buying, selling, because in share the prices change significantly. Bond and all, no daily change. Daily change will be there. For example, if it's a 100 rupee bond, Every day this bond will change by 8 divided by 365. 8 divided by 365 is 1 day interest. 8 divided by 365 is 1 day interest, which could not will be some 2 paise, 1 paise. So it will go up by 2 paise every day. You will have to wait till at least you recover your transaction cost. You will have to wait till you recover your transaction cost. So now write number of days to break even transaction cost. Number of days to break even transaction cost. Point number A, transaction cost is equal to 100 into 2%. Another important part here also is, sorry, I did not discuss this, bond is available at par, which means you are earning 8%. Bond is available at par, so you are earning 8%. You are earning 8%. If bond was not available at par, then the earning is also different, and the transaction cost also would have changed. The transaction cost would have also changed because it will not be 2 rupees. It's not going to be 2 rupees. Point number B, bond yield. Bond yield is equal to 8%. Bond available at par, and hence yield is equal to coupon. Just do one thing, leave the transaction cost as 2% itself, because here 2 rupees will not make a difference, but some other problem, if it's at a premium, you write 2 rupees, you will get confused, you'll end up making a mistake. So let it be 2% as it is. Let this be 2% as it is. And simple part is 8% is equal to 365 days. You will earn 8% in 365 days. 2% is question mark. Tell me in how many days will you earn 2%, because you will break even then. 8% is equal to 365 days. 2% in how many days? So number of days to break even is equal to 365, sorry, 2% by 8% into 365 days. 2% by 8% into 365 days. 91.25 days. You can round off to 91, 92. Sometimes I say it as 92, sometimes 91. I leave it as 91.25 days. Any doubts on this? No, I'm not assuming 1 year. I'm not assuming 1 year. Basic thing is you'll have to stay in the bond for minimum 91 days for you to recover the transaction cost. No, 8, the yield is always for a year, no? 8% is always a yearly yield only, no? Whenever a bank, if bank says interest rate is 7%, that is for a year. Just because you have created a 5-year FD, you will not say interest is 35%. So yield 8% is always for a year only. So here I'll take 91 days to break even, which indirectly means if you invest in this bond instrument and suddenly you say you will need money back, please don't invest. At least have a mindset of minimum 91 days. Then only you will recover the transaction cost. After that, you will earn something. So as you stay for longer period, you will keep earning more, because transaction cost is only one-time expense. It is a one-time expense. If you suddenly sell it in between, you may not even recover the transaction cost. Any doubts on this? You can go through the question and solution. I'll wait for a minute. Let me know if there are doubts. Anywhere there are doubts, please let me know. First segment should not be a challenge. Anything on the transaction cost, let me know. Hmm. Which part of the question you're asking? Transaction cost part. If it is a discount or premium, then I have to first calculate IRR. I'll have to calculate IRR, which is going to take some time. You'll have to do that calculation, which is the next problem. Next problem, I'm going to explain how to calculate IRR, what we do. But I'll have to go ahead and calculate IRR. If IRR is 9%, that is the pre-tax number. Pre-transaction cost number. post transaction cost is 9% into 1 minus the brokerage, or directly consider the transaction cost in the IRR calculation itself and then get to the answer. But if it is not quoting at par, you cannot say yield is 8%. It's either more than 8 or less than 8. Okay, let's take a break of 5 minutes. Okay, let's continue with the discussion. Let's move to 64. Go through the problem. Go through the problem and do part 1 quickly. Go through the question, you complete part 1. Part 2 is something I'll take you through. Start doing part 1 of the question. It will not need any explanation also. Part 1 can be done without any explanation from my side. Do part 1 quickly. Maximum purchase price is nothing but the fair value of the bond. Maximum purchase price is fair value of the bond. The bond is paying a coupon of 11%. Investor wants a return of 13%. Bond is paying 11%. Investor wants 13%. It's a 3-year bond. So 1 to 3 years 11. At the end of third year 100. We discount this at 13%. We are doing discounting of this at 13%. Any doubts on this? Clear? Can we proceed? If bond is selling for 97.60, what would be his yield? The requirement is asking what will be the yield. If at all the question had said, if bond is selling for 100, what would be his yield? Yield is equal to coupon rate. Yield is equal to coupon rate. Now it is selling at 97.6. What is the fair value you calculated? 95.27. According to you, this is just for you, because for someone else it could be different. According to you, it is an overvalued security. According to you, it is a overvalued security. Finally, the yield which you can get will be lesser than 13%. Finally, the yield which you can get is lesser than 13%, because it says at 13% it's 95.27. If at all I had done at 12%, just a random number, if I do 12%, the value will go up. Somewhere I want to know what will take it to 97.3. What is going to take this to 97.3? Now, yield, we have 3 ways of doing the yield. What ICI wants when problem is silent is the third approach. I'll give you all the 3 approaches, because understanding of 3 approaches will help you. Now write yield and split into 3. Current yield, YTM shortcut, YTM IRR. Yield split into 3. Current yield, YTM under shortcut method, YTM as per IRR method. YTM under shortcut and YTM as per IRR method. What is YTM? Is yield to maturity. Current yield is very simple. Current yield is basically trying to say that it is like a 1 year bond. It is like a 1 year bond. Current yield is nothing but what you get divided by what you give. The formula is what you get divided by what you give. What you get every year is interest. What you give is current market price. What you get divided by what you give. Any return, this is the formula only we'll be using. What you get divided by what you give. Interest by current market price. Interest is how much? 11, 11, it's 11 rupees because I wanted rupees. 11% on 100. What is the current market price? Into 100. Tell me the percentage. 11.1. Okay, 27. 11.27. This is approximate return. This is just an approximate return which you can get. This is an approximate return which you can get. 11.27%. Again, this is not needed for all the problems. First question I'm doing it unless the question specifically tells current yield. This current yield is what I was explaining when I did that, saying 8 by 101. 8 divided by 101 was nothing but that current yield formula. 8 divided by 101. Shortcut is whenever you do IRR, the initial headache is what rate to start with, what discount rate to start with. Because for me, in doing in Excel is very simple. I need not take any one positive, one negative, and all is not needed. Whenever we do a problem, we struggle. So for that, we first get a shortcut answer. Final answer is going to be closer to the shortcut answer. Now, what shortcut answer says is cost of redeemable debt. You would have learned at inter level, saying that there is an interest component, there's an average other cost component. What is average other cost? Is there will be a redeemable value, there will be a net proceeds today, divide by life you used to do, and you used to whole divide this by average funds employed. If you remember, there used to be a formula called interest after tax plus redeemable value minus net proceeds by life divided by redeemable value plus net proceeds by 2. There used to be a formula something like this. Exactly same logic. I'll be using that formula, but I'll get the logic now here. Whenever I invest, I get interest every year. That is one part of it. Okay, interest plus along with that I may get some additional income. Along with that I may get some additional income. What additional income? What is the price today? 97.6. But when they redeem, they'll give you 100 rupees. When they redeem, they'll give you 100 rupees. So you get extra 2 rupees 40 paise. One, you get interest. Second, you get capital gain. So it's interest plus capital gain. Technically, interest plus capital gain. The only difference is interest is paid every year. Capital gain is one time. Capital gain is one time. So capital gain part is redeemable value minus net proceeds. That is today's value. Redeemable value minus, or you can say redeemable value minus current market price divided by life. Redeemable value minus current market price divided by life. Let me write the formula properly. Interest, one part, redeemable value minus current market price. I'll give you time to write, listen. Divided by balance life, whole divided by redeemable value plus current market price by 2. This is just to take the average of the opening and closing balance. Average of the opening and closing balance. What is the interest the bond will pay every year? 11 plus 100 minus 97.6 by 3. 100 minus 97.6 by 3 whole divided by 100 plus 97.6 by 2. You will get an answer. You can do the calculation. I'm repeating here. Interest is one component of the income. There's an extra income. Some rare scenario, this extra income can be negative. How can it be negative? You paid 105 today. Redemption is happening at 100. So you have a capital loss. You have a capital loss because you paid 105. You got back only 100. Normally you will have a capital gain, but there can be a capital loss as well. So interest plus capital gain divided by life divided by opening capital plus closing capital by 2. Opening capital is what you pay. Closing capital is what you get back on the last day. Opening plus closing by 2. Now write under shortcut interest plus redeemable value minus current market price by balance life. Redeemable value minus current market price by balance life. Again, I don't want you to remember the formula. Whole divided by redeemable value plus current market price by 2. Redeemable value plus current market price by 2. In simple words, you can understand it as interest plus annual capital gain. Interest plus annual interest plus annual capital gain. Interest is anyway annual. Capital gain, how you can make annual? Divide by the number of years. 11 plus 100 minus 97.6 by 3 whole divided by half of 100 plus 97.6. Tell me the shortcut answer. 11.94. My final IRR is going to be closer to this. In exam situation, I don't want you to present this. Reason is, in case you end up making a mistake, it should not impact the, ideally examiner would not be worried even if you make a mistake, but even if you end up making a mistake in this calculation, my IRR approach is not going to be impacted. The only challenge is if you make a mistake here, you will not get one positive, one negative easily. It will take you more time. It will take you more time to get one positive and one negative NPV. If you do this correctly, my final answer ideally will be, I think, closer to 11.9. For high probability, this question can be 12%. I'll do the calculation, but it can be 12%. We'll do the computation. So once you get the shortcut, we are going to start with NPV now. When I do NPV, I'll first start with 12%, which is closer to 11.94. Positive NPV, increase the rate. Negative NPV, reduce the rate. One positive, one negative, and you get to the IRR. That IRR is called YTM. Now wait. Why is this called YTM? Is yield to maturity. Yield to maturity means what return will you get if you hold on to the bond till the last day. Yield to maturity means what return will you get if you hold on to the bond till the last day. Because the term is called yield to maturity, there's no concept of a YTM for an irredeemable bond. If you have an irredeemable bond, you can only calculate current yield, because irredeemable bond does not have a life. There is no end. So yield to maturity needs a end. Yield to maturity needs a end. So if you have irredeemable bond in a question, only way to calculate is this. That's all. Interest by current market price. And this interest by current market price is also not something new. K is equal to D1 by P naught. D1 is interest, P naught is current market price. K is equal to D1 by P naught. Ignore the growth rate component and all, because growth and all will not come here. K is equal to D1 by P naught. D1 is interest of first year. P naught is current market price. P naught is current market price. That is what current yield formula is. So current yield is nothing but cost of debt. The formula is interest by current market price. Logic is very simple. It is dividend by, your mind should always think, whenever you're trying to calculate any return, what do you get back divided by what you give. What you get back divided by what you give. So suddenly exam asks you some twisted numbers. At least if you're clear on the concept, saying that in return means I'll calculate like this. What am I getting back divided by what am I giving. So shortcut to, sorry, current yield is 11.27. Shortcut is 11.94. Any doubts on 11.94? Any doubts on the formula? If you have tax, everywhere tax will be there. So the formula is interest after tax technically, but tax is not there in this question. We have one problem, I think, with tax. I'll explain there. Now, next, computation of YTM. Computation of YTM. This is the only thing question wanted. When they ask yield, problem is silent. You just need to do this. What you need to ideally do is, in your calculator, do the shortcut answer. In your calculator, do the shortcut answer. In class, 2-3 problems you can write and do, but what I need is only the shortcut answer in the calculator. Using the shortcut, I'll get to the detailed YTM. We'll open 4 columns. We may need space for 4 more columns to do NPV, because one positive, one negative. Year, cash flow, PVF, DCF. Another 2 columns PVF, DCF. Another 2 columns PVF, DCF if needed. I don't know. So let's first open 4 columns. Year, cash flow, PVF at 12%, DCF 0, 1 to 3 and year 3. Year 0, 1 to 3 and year 3. Year cash flow, PVF at 12% and DCF. Year 0, 1 to 3 and year 3. What is the year 0 cash flow? Minus 97.6. 1 to 3 we are going to get 11. At the end of year 3 you are going to get 100. Tell me the 3-year annuity factor. 2.40. Okay. I think we are done here because we have got almost a zero NPV. So 12% is the direct answer here because we have got a zero NPV. But a lot of problems you will not get directly a zero. 0.0 is almost close to zero. So there's nothing much to be done here. So below this you can write IRR of cash flow. IRR of cash flow is equal to 12% and hence yield to maturity. Yield to maturity is 12%. Whatever answer you get under shortcut, the detailed answer will be closer to that. It can be slightly up, slightly down, but it will be closer to that number. So the IRR was 12%, YTM is also 12%. If you have an irredeemable instrument, be very clear. For an irredeemable instrument, I can have only current yield. Because I cannot calculate YTM. YTM is something which cannot be computed because we have restriction, and the issue I have is YTM needs a end period. It needs a end period. And the other thing is, this is basically perpetuity valuation formula. This is technically the perpetuity valuation. Current market price is equal to interest by current yield. So technically you are using the perpetuity valuation because there is no end here. Any doubts on this? Can we proceed? Any doubts? Okay, let's come to 65. Calculate the market price of a 10% GOI security currently quoted at 110, but yield is expected to go up by 1%, 7.5% coupon interest, face value 10,000, term to maturity, presently yielding 6%, interest payable half yearly. Not much to read. Let me explain the question and then we start doing. 10% is the rate of interest currently quoted at 110. One information which got missed out, which ideally they should give. I'm assuming face value to be 100. Looking at 110, I'm assuming it to be 100. A 10% government bond is quoting at premium. It is currently quoting at premium because the value is 110. Company is paying 10%. Can you tell me what will be investors' expectation? More than 10% or 10%? What will be investors' expectation? It's less than 10%. It is just because I gave you two options doesn't mean the answer is there in that. The question said it is a 10% government of India security. It is quoting at premium. When will it quote at premium? If the coupon is more than the investor's expectation. If the coupon is more than the investor's expectation. So investors' expectation somewhere has to be less than 10%. But yield basically would mean investors return, investors expectation, whatever yield they say. So they are saying today I don't know what is investors expectation. The investors expectation will go up by 1%. The investors expectation or return will go up by 1%. Whenever this changes, you will see price changing. Yield and price is inversely proportional. Yield goes up, price will go down. Any whatever problem you did with that problem, 8 became 9, 7.75, 8.25. As you increase the yield, your price kept on going down. The yield and price of the instrument is inversely proportional. See, earlier, good part, I'm very happy that MCQ got introduced. Because MCQ got introduced, suddenly they may ask you something like this also. What is the relationship do you see between the yield and the price of a bond? Because for that they won't expect you to solve a question and then give a conclusion. You will have to be very clear on the base logic. So the concept clarity there, you will be able to answer this. So the yield of an instrument and the price of a bond is inversely proportional. In short, this 110 is going to go down. Is there a life given here? Is there any information on life? So I'll have to follow the current yield approach. I'll have to follow the current yield approach. So first what I'll do is I'll calculate the current yield. Then this current yield will increase by 1%. Again, use the same formula. Market price will be balancing figure. Market price is going to be balancing figure. This is part 1 of the question. Part 2 I'll explain in some time. Any doubts on part 1? Because life is not there, it is current yield. If life was there, it is yield to maturity. It is yield to maturity. You have to first originally calculate the IRR, increase that YTM by 1%, then do the revised calculation and get to the answer. Because life is not there, this yield would mean current yield. Any doubts? Clear? Let's start. Point number A. Current yield is equal to interest by current market price. Interest by current market price 10% into 100. Assumption is face value is 100. Okay, you can write that assumption. Face value 100 is assumption. 10% into 100 divided by 110. Divided by 110. What's the current yield? 9.09%. Company now they are saying no, we are not going to work with 9.09. People are expecting now 1% more. People are expecting 1% more. Yield, you can call it as investor's expectation. Yield, you can also call it as what investor is earning. So investor is today earning 9.09. Now suddenly investors are saying 9.09 is not okay. We want 10.09. What can be the reason? Two reasons. One, the risk of the company has increased. How can risk of the company has increased? Example, Yes Bank. Yes Bank, it was at some stage very safe. Later on, it got into troubles. So people started believing. Now it has come out of trouble to a great extent, but still people have some doubts on the company. Some worries are there. So the risk can go up. Or RBI has increased interest rate. When RBI increases interest rate, risk-free rate goes up. So if risk-free rate goes up, my return risk-free plus that premium should also go up. Risk-free plus the premium should also go up. One way of valuing. So for example, if I give you a loan, and what interest to charge, logical thinking is RBI's, our government of India is giving 6%, which is risk-free. Okay, this is a known person. I need only extra 2%. You give it to an unknown person. I need extra 4%. You give it to someone else. You need extra 6%. This extra number is subjective. The extra number is subjective, but the only logic is if risk-free rate is increasing, yield will start going up. If you have tracked, bond market is something you wouldn't have tracked, but what would have happened to the bond prices is in the last 2 years or in the last 1 year, especially when RBI increased interest rates, the bond prices would have gone down. The bond prices would have gone down. Why will bond prices go down? The reason is simple, because investors' expectation has gone up now. Why will investors' expectation go up? Because if you are not going to pay me that extra return, I'll go to some other bond, because every bank has started increasing the interest rate. So in the market, automatically the price would have crashed down. Automatically the price, when price crashes down, what happens? I get my return of extra return. I will end up getting that extra return. Earlier I was getting 10 rupees on 100 rupee investment. Now I'll get 10 rupees on 90 rupee investment. Then I'll get 10 rupees on 80 rupee investment. As you see a crash here. So here, next line, right? Yield increase by 1%, and hence revised yield is 10.09%. Revised yield is 10.09%. Wherever question says interest rate has gone up, yield has gone up, everything means YTM or current yield going up. The bond interest rate can't change. For example, this question says interest rates went up by 1%. Coupon of 10 will not become 11. Coupon of 10 is not going to become 11 because the bond will continue to pay only 10%. The question will say the interest rates in the economy have gone up by 1%, which means please increase the YTM by 1%. Increase the YTM by 1%. You cannot change the bond's interest. The coupon rate of the bond cannot change. Why it cannot change? Because the coupon rate of the bond is going to remain fixed unless we have a structure called variable bond, which I'll explain later. There's one problem on a variable bond, but otherwise bond will continue to pay the fixed 10%. Now again, right, current yield is equal to interest by current market price. 10.09% is equal to 10 by current market price. It will be at a slight discount because we are not meeting the expectation. Slight discount will be there because people want 10.09, we are giving 10. 99 point. Okay, okay. So it will quote at slight discount. This problem could have become more lengthier if it was YTM approach. YTM approach means you'll have to first calculate the YTM, increase the YTM, and then do the revised price calculation. YTM will take at least 3-4 minutes for you to do because there is an extra computation which is needed. Any doubts on this? Can you proceed? Next is a bond with 7.5% coupon interest, face value of 10,000, term to maturity of 2 years, presently yielding 6%. Presently yielding 6% means it is giving a return of 6%. Presently yielding 6% means it is giving a return of 6%. Coupon is 7.5%, but it is not giving 7.5% return because return is coupon plus or minus capital gain. Coupon plus or minus capital gain. So here I am paying 7.5%. Capital gain is going to be negative here. Why will it be negative? Is I am exceeding the expectation of the investor. Bond will quote at premium. You will pay more than 10,000 but get back only 10,000. You will be paying more than 10,000 but you will be getting back only 10,000. So in short, coupon here is 7.5%. Yield basically means investors expectation discount rate. The investors expectation are the discount rate. One important part is it is a half yearly bond. It is a half yearly bond. Half yearly bond calculation will be changing slightly. Now listen for 2 minutes. Till now I have always used the word year, but it's not year. We should ideally use the word period. Period means it can be months, it can be quarters, it can be half years, it can be years. So in this question, they've asked us to calculate the price 1 to 4. What is 1 to 4 is the bond has 2 years life, but it's not 2 years, it is 4 half years. Bond has 2 years life, but it's not 2 years, it is 4 half years. Listen for some time, I'll give you time to write. 2 years, it's not a 2-year bond, it is a, because I'll be explaining this exactly after 10 or 15 problems. Will be valuing a half yearly bond. You will end up doing annual discounting, end up making a mistake. So be very clear on the thought process. And half yearly bond, you'll have to write half yearly cash flow. An annual bond, you'll have to write annual cash flow. A quarterly bond, you'll have to write a quarterly cash flow. So this is not 2 years life, it is 2 years or 4 half years. It is 4 half years because the interest is payable half yearly. The interest is payable half yearly. So 1 to 4 at the end of year 4. At the end of not year 4, at the end of half year 4. At the end of half year 4. Tell me the cash flow. How much is the half yearly interest? 375. 375 is the half yearly interest. 10,000 into 7.5% into 6 by 12. The coupon interest is normally yearly interest. The coupon interest is normally yearly interest. At the end of fourth half year, you will get 10,000. You will get 10,000. Any doubts till this? It is a half yearly bond. 10,000 into 7.5% into 6 by 12 into 7.5% into 6 by 12, and redemption will happen at par. Problem is silent. What is the yield they have given? Yeah, please tell me the number. So now listen. Life is here. You may write this in some time. 2 years or 4 half years. Coupon is 7.5% per annum or 3.75%. per half year. Yield is equal to 6% per annum. Normally, yield, interest, everything is for a year. Or because when you go to a bank and ask a fixed deposit rate, you'll say, give me a 15 days FD rate. They'll say 15 days FD rate is 3%. It means it's 3% per annum. It means it's 3% per annum. Nobody will pay for 15 days 3% absolute amount. It is going to be always a yearly rate. And what people understand is only yearly rate. If suddenly they say 15 days is 0.25%, 30 days is 0.5%, 100 days is this much, you will not be able to compare itself. Because how what normally people compare is, okay, 3%, 3.5%, 4%, 4.5%, you will see the FD rates keep going up as the period goes up, and suddenly there will be a maximum rate and then it will also go down. So you will try to look at only the annual rate. That is how your mind thinks. Or normally in a practical world, people think at a yearly level. If I ask you what is the return you earn, you will say I earned a return of 1%. I'll be thinking what is this 1%? Then you're saying it's 1% for 2 days. I don't understand this 1% for 2 days. You'll have to tell me yearly rate. Always, whenever people ask you what is the return, the expectation is you will say yearly rate. Suddenly you say I earned a return of 5,000%. I'll be very great. And then you say 5,000 percentage is for some 50 years or some 100 years. So then only I'll get to know the real return. So the real return is always a yearly rate. So yield is 6% per annum or 3% per half year. Wait for some time, okay? This is correct. This is also correct. This is technically wrong. This is technically wrong, and ideally you should not be doing this. This is technically wrong, but every problem we'll do this only. Every problem we will do this only, but technically 6% for a year does not mean 3% for a half year. Coupon of 7.5% means 3.75% because that is how the bond is going to pay. That is the interest the bond is going to pay. But what happens in yield is, listen, there is a bond which pays, let's assume 3%, 3% per half year, okay, and there's another bond which pays 6% year. Both are not same. How it's not same? 100 plus 6 rupees, 106. 100 plus 3 rupees, 103. On this 103 I'll get 3%, which is 3.09. On this I'll get 3%. On 100 I got 3%, 3 rupees. On 103 I'll get 3%, which is 3.09. It adds up to 106.09. So 6% return for a year does not mean 3% for a half year. Does not mean 3% for a half year. But for simplicity's sake, in practical world also, many a times in discussion, you do the 6% for a year as 3% for a half year. What is that exact rate? I'm showing you the calculation, but it's not needed in exam. Not needed in exam, except for one question I think where I may do it, but otherwise it's not needed from an exam point of view. 6% for a year will take 3% for a half year, but technically 3% is wrong. Now you could have come across this formula also. Effective rate of interest is equal to 1 plus r power n minus 1. 1 plus r power n. This is whenever you have a shorter compounding frequency. Whenever you have a shorter compounding frequency, you use a formula called as effective rate of interest, which is in this example 6% is the effective rate for a year, is equal to 1 plus r square. What a square is, in 1 year you have 2 half years. In 1 year you have 2 half years. So if you want to know what is the half yearly rate, you will have to use this 1 plus r square minus 1. 1 plus, if you want to know quarterly rate, 1 plus r power 4. 1 plus r power 4. You want to know monthly rate, 1 plus r power 12. 1 plus r power 12. So this 1 goes the other side. 1.06 is equal to 1 plus r square. Can you take a square root and tell me r? Take a square root, subtract 1. 1 plus r square. Take a square root, subtract 1 into 100 to express in percentage. It will be 2.9 some number. 2.995. Okay, 95 or 96, 2.96%. So basically 6% for a year would mean 2.96% for half year. 6% for a year would mean 2.96% for a half year. Practical world, a lot of places this will be used, but in exam problem solving, I'm not going to do it. Also, this concept, this effective rate is very critical because somebody will say, I have a 8% FD which pays quarterly interest, and you have another FD which pays 8.25% payable annual. Your parents ask you which is better FD. Now don't say 8% directly, because 8% is paying quarterly, 8.25% is paying annual. Do some calculation and then tell which is better. What is the calculation? Effective rate is equal to, if it's paying 8%, it will pay 2% every quarter, power 4 minus 1. 1 plus 2% power 4. 8% for a year, payable quarterly. Payable quarterly. So every quarter it will pay 2%. Every quarter it will pay 2%. 1 plus r power n minus 1. This may turn out to some 8.10% or 8.15, 8.15. I don't know. Just check the number. 1 plus 2% power 4 minus 1. What's the number you're getting? 1.02 power 4 minus 1 into 100. 8.2. Okay, technically both are same. Technically both of this are same. When you go to a bank and take a FD, they'll say 8% interest, but effective rate is 8.24. They will give this number in their rates itself. In the rate, they'll say effective rate is going to be so much. When you take a loan, this rate will not be given, because when you take a loan, they'll just say the base rate. Effective rate is going to be higher because you pay every month. You pay every month. So if you pay every month, 1 plus 9% if you pay, which is 0.75% for a month. 1 plus 0.75% power 12 minus 1 is the effective rate. Power 12 minus 1. Whatever I discussed is time value of money, whether you use it for problem solving or not, but you may have to use this in practical world, because some questions like this can come from a person. Suddenly your friend or parents may ask, we are going to take a loan at the 7.5%, it is okay, let's take. Then you will have to advise them 7.5 is okay, but effective rate is 8.5. I'm just advising you, it is effective rate 8.5. Then we can decide whether you want to take a loan or not, because effective rate is 1 plus r power n minus 1. All these concepts are very critical. Whatever you learnt in initial time value of money is going to be extensively used in practical world. Suddenly in some random problem, I'll be using equated annual installment, which is using annuity factors and getting to know how much is the equated. Suddenly your parents may ask, I'm going to take a loan of 50 lakh. It is going to be at 8% rate of interest, 20 years. Can you tell me what is the EMI going to be? One approach is using a calculator, but at least be very clear on the logic and then try to calculate. EMI is equal to loan amount divided by present value annuity factor. Once you do that, you'll get to know the EMI amount. Suddenly they'll say, from 20 years, if I increase it to 25 years, what will be the EMI? If I reduce, what will be the? So all that thought process should be clear, because at final level, at least that is the minimum expectation which people will have from you. When they ask you something like this, you should be in a position to address that doubt. So understanding this effective rate is very critical. Understanding this effective rate is very critical, because in practical world, there are a lot of application of this. Without having an understanding of effective rate, you will end up making a mistake. 8 vis-a-vis 8.1, you will advise take 8.1. In reality, if you had taken 8, you would have got more money. You would have ended up getting more money. At least that part you will have to educate people. So that is something you should also be first aware of, saying that there is something called as an effective rate constant, which is 1 plus r power n minus 1. Again, formula is something I don't want to know. I could have got this effective rate using this logic also. 100 plus 2 rupees, 102 plus 2.04. 104.04 plus 2% you do, plus 2% you do, you'll end up at 108.24. You'll end up at 108.24, which is 8.24%. So every formula has a base math which goes behind it. Try to understand that base math. All base math I cannot explain in the class because it will take away a lot of time. But some of the things you should be very clear on the base math. Now, whatever I said for effective rate is more for your understanding. Again, I'm repeating, it's more for your understanding. One or two places I'll use it in problem solving in this chapter and some other chapter also. One or two places only will use it. Effective rate is equal to 1 plus r, the whole power n minus 1. This is the annual rate which you are getting. The annual rate in this example is 6%. Half yearly rate you reverse work and calculate. If somebody says you are going to pay 3% per half year, can I make it 6% for a year? For a problem, yes. But in reality, it's not 6% for a year. It is going to be higher. It's going to be higher. So in this question, life is 2 years or 4 half years. Coupon is 7.5% or 3.75%. Yield is 6% or 3% per half year. So PVF at 3% you will do and calculate the answer. Whatever the time value of money tables you have or you calculate, that is not for a year. That is for a period. That is for a period. And whatever interest rate you use, you will have to use it for that period. So if you want to do half yearly calculation, you'll have to use the half yearly interest. That is why we are using 3%. If you're doing quarterly calculation, you'll have to use the quarterly yield. If you're doing annual calculation, use the annual yield. If you're doing annual calculation, use the annual yield. When you do 1 divided by 1 plus that rate does not mean it's annual rate. It can be half yearly rate, it can be quarterly rate. If you're doing quarterly rate, you're doing quarterly periods. If you're doing annual rate, you're rating annual periods. If you're doing half yearly, you'll write it half yearly. So before you do the calculation, first write these three lines. Life is equal to, write this, life is equal to 2 years or 4 half years. Don't write the table. Life is equal to 2 years or 4 half years. Coupon equal to 7.5% per annum or 3.75% per half year. Yield is equal to 6% per annum or 3% per half year. 6% per annum or 3% per half year. Before you write the table, I just need 2 lines of explanation. Bond is paying half yearly interest, and hence we should discount we should discount we should discount half yearly cash flows. We should discount half yearly cash flows at investors half yearly required rate of return. Investors half yearly required rate of return. The return also should be half yearly, cash flow should also be half yearly. If we do annual, you will get a difference in answer. ICA will not award marks, and in fact they should ideally award 0 only if you do annual discounting, because it's technically fully wrong. You are going entirely wrong in the calculation. Now listen, a half yearly bond, a 2-year half yearly bond with a 6% investors required rate of return will give the same answer as a 4-year yearly bond with a 3% expectation. If it's a 4-year yearly bond and they were expecting, half yearly bond 3% expectation, yearly bond 6% expectation, you will end up getting the same answer. You'll end up getting the same answer. So now period 1 to 4, period 4, cash flows are written, discounted 3%, put a total, that's the answer. Complete this. At 3%, do PVF at 3%, DCF. Be very clear, half yearly bond, I want half yearly discounting. Despite me telling so many times, you will end up making a mistake later on. So be very clear on this area. It is quoting at premium because it's exceeding the expectation. Exceeding the expectation. Bond is paying 3.75%. Investor wants only 3%. Exceeding expectation. It is quoting at premium. Clear? Calculation. Okay, if at all you guys want to write this, you write it here. Effective rate of interest is equal to 1 plus r power n minus 1. This is just for your understanding. Don't try to do it in exam problem. One place I may do it, that's all. 6% is the annual rate, which is equal to 1 plus the half yearly rate power n minus 1. 6% is 0.06. 1 goes the other side, 1.06. Clear? Done? You can go through the solution, both the parts. If there are any doubts anywhere, let me know. No, why you can't do that is, if bond is paying 7.5% for a year, they'll pay 3.75% because that the coupon rate is 7.5%. How interest is calculated is 10,000 into 7.5% into 6 by 12. So the interest amount is going to be 375. 10,000 into 7.5% into 6 by 12. Interest will not have any effect there. Any doubts in the earlier question? 66 is homework. Go through 67. Okay. What is the value of a 5-year 11.6% coupon bond if the appropriate discount rate for discounting each year cash flow is as under 11.8, 12.8, some different discount rates are given. I did an area called multiple cost of equity where I said something. We did calculation. We used the that year cash flow for discounting. That year discount rate for discounting that year cash flow. In that, I did one adjustment. I said I'll explain that adjustment in bond valuation. So that adjustment is what is going to come here. What is that adjustment? You'll understand as we proceed. Let me take an assumption of face value of 100. Now let's first understand what does this table mean. First year, people are expecting 11.8% interest. Today, I believe 1 year later, this company will go into some financial trouble. That's my assumption. So next year, I need extra return, 12.8. Next to next year, my return expectation is 13.2. It is only for that year, okay? First year, I want 11.8%. Second year, I want 12.8%. Why am I needing an extra return? Two possibility. One, the company may get into trouble, which is a lesser possibility, because if it's going to get into trouble, your expectation will be high from the beginning itself. The later expectation is RBI increasing interest rates. RBI is increasing interest rates. So RBI is going to increase interest rates. You believe inflation is going to go up. So you want first year 11.8% return. Second year you are saying 12.8%. Third year you are saying 13.2%. Fourth year you are saying 13.8%. Fifth year you are saying 14.6%. When this happens, one, you cannot use the annuity factors because the rates are different for each year. So I'll have to first write year cash flow, which is the normal manner. PVF calculation has a slight variation. That variation is what I want to explain here. Let's first put the cash flow. Face value 100 is assumption, right? Year cash flow PVF DCF. PVF at what rate we cannot write because the rate is going to be different for different years. Year cash flow PVF DCF The bond is going to pay interest of 11.6. Last year triple 1.6. You want to write year 5 two times, that's your wish. Principal separately, interest separately. I'm clubbing it together. Listen for some time and then you can write now onwards. Listen for some time. First year, tell me what is the discount rate? 11.8%. 0.894, whatever number. Second year, the discount factor is 12.8%. Now, there are two ways of getting to this 12.8. One is the right way, other one is the wrong way, which I'm going to teach. One way is 1 divided by 1.128 you do. Then again, you divide by 1.128. First, you 1 divide by 1.128. Again, you do an equal to, you get the second year factor. So, 1 divided by 1.128 square. This is one approach. Second approach is 1 divided by 1.118, which is the first year discounting you did. Second year factor is 1 to 8. Let me explain first two approaches. 1 divided by 1.128, when you do, you get the first year discount factor. You get the first year discount factor. For the second year discount factor, you eliminate whatever you did and you start fresh. 1 divided by 1.128 divided by 1.128, which is wrong way. That is the wrong approach. Now, why is this a wrong approach? This was a doubt which you had asked me in the last session. Now, why is this a wrong approach? I need to do discounting of cash flows. So, first from year 2, I want to take it to year 1. I want to take the cash flow from year 2 to year 1. How will I take it? By discounting it at 12.8%. By discounting this at 12. From year 2 to year 1, only 1 year. From year 1, you want to take it to year 0, you will have to do discounting of 11.8%. You will have to do discounting of 11.8%. Why is this happening? Because the expectation of returns are different for different years. So, first year cash flow, whatever you get, discount at 11.8%. Second year cash flow, whatever you get, discount at 12.8%, bring it to year 1. Then discount at 11.8% and bring it to year 0. Third year, whatever you get, discount at 13.2%, bring it to year 2. Discount at 12.8%, bring it to year 1. Discount at 11.8%, bring it to year 0. Now, you're not going to do so many discounting and get to the answer. What approach you will do, I'll explain. But logic is this. Logic is, I cannot use 1 divided by 1.128 power 2, which few students have done in exam. That is a wrong way of doing it. Why is it a wrong way of doing it? Because if you do 1 divided by 1.128 power 2, you're indirectly saying this whatever you get in the second year, I'll discount by 12.8% for year 2, also by 12.8% for year 1, which is wrong. Whatever you get in year 1 will have a discount rate of only 11.8. Whatever you get in second year. So what I can do is, I got some money in the fifth year. I don't want to write that in the fifth year. I want to bring it to the fourth year. So I can do it by discounting 14.6. Now I have two numbers in year 4. I don't want these two numbers. I want to take it to year 3. Discount by 13.8 and take it to these three numbers. Discount and take it to year 2. Then discount and take it to year 1. And then finally do the discounting and get it to year 0. So the discount factor, what we do is, first factor is 1 divided by 1.18. Second factor is whatever is there in the first year. Whatever is there in the first year, divide by 1.128. Wait for some time. Whatever is there in the top, divide by 1.132. Whatever is there, divide by 1.138. I'll give you time to write. Don't be in a hurry to write. Whatever is there, divide by 1.146. Now, what this discount factor of 0.509 indicates is, whatever number 111.6 you are getting, you're going to discount that by 14.6 first. After discounting this by 14.6, you're going to discount by 0.583, which is what? Discounting of 13.8 of fourth year, discounting of 13.2 of third year, discounting of 12.8 of second year, discounting of 11.8 of the first year, and then you get to year 0. Alternately, sometimes students do, which is the error approach. That is, you do this and then you do 1 divided by 1.128 power 2, which is the wrong way of doing it. You will see variation. You will see variation in the discount factor. So whenever there is a step up or step down discount rate, whichever year cash flow is there, that year discount rate you will have to use. So for a fourth year cash flow, I need the fourth year discount rate. But how will I get that PVF is take the earlier PVF and divide by 1 plus the new discount rate. Divide by 1 plus the new discount rate. So in our calculation, what we are going to do is 1 divided by 1.18, get the first year, don't do anything in the calculator, divided by 1.128 equal to second year, divided by 1.132 third year, divided by 1.138 fourth year, divided by 1.146 fifth year. You keep writing the factors. Clear? Any doubts on this? Any doubts on this? I cannot. So just you do 1 divided by 1.1, that 18 you do, you write a equal to, then you delete and start from the beginning. It's not going to work. It's one, waste of time. Second, you'll end up making a mistake if you do 1.128 two times. So logic is simple. Second year cash flow has to be brought to first year. How do I bring it? By doing reverse calculation, by doing the reverse calculation. Do this now. Balance is simple. So I'll just write one thing in the side. You may write this in your notebook. PVF of year 2 is equal to PVF of year 1 divided by 1 plus discount rate of year 2. PVF of year 2 is equal to PVF of year 1 plus the discount rate of year 2. These two notes alone you write it below. Balance, it goes on like this. PVF of year 4, year 5, year 6. There's no end to this. Okay, sorry, I made an error there. Okay, yeah. 1.118. Again, this is something can get tested in an MCQ. They may end up asking something on this in an MCQ. This is called step up or step down discount rate. I may use this concept anywhere. I'll later on do business valuation. I may use it there. In equity valuation also we could have used this. So it can get employed anywhere. Wherever there is a change in discount rate, you will have to use this. Any doubts in this? You can go through the computation. Let me know if there are doubts. There's nothing much except for that formula which I've written in the side. And this also I've just written so that you remember when you check the solution. Otherwise, there's nothing there in the question. Go through the solution. Let me know if there are doubts. Done? Sure. Anywhere there is a doubt in this, please let me know. Some new concept will keep getting added. So I explained about a half yearly bond in the earlier question. This question is testing on a concept called step up or step down discount rate. The first problem we did was base valuation. The next problem we had transaction cost adjustment. So something or the other will keep getting added on. Any doubts on this? Can you proceed? I'll explain 68. We'll do it later because it needs a little bit of more explanation. Let's come to 69. Let's come to 69. Messrs. Agwa Industries is planning to issue a debenture series on the following terms. Term of maturity 10 years. Yearly coupon 1 to 4 is 9%. 5 to 8 is 10%. 9 to 10 is 14%. Current market rate on similar debenture is 15%. Company proposes to price the issue in such a manner that it can give an yield of 16%. Redeem the debentures at 5% premium. Determine the issue price of the debenture. Go through this. Okay. This has some differential interest rate. This is not a variable bond. A variable bond is one where the interest rate changes based on RBI changing it or some external benchmark changing it. So according to the terms, they are saying we'll be paying 9% initially, 10% for next 4 years, and 14% for the last 2 years. What does this mean? 15%. What does this 15% mean? Now, how is this going to be used in our calculation? How do you want me to use this 15%? The discount rate, the current market rate on a similar debenture is 15% per annum. That is technically investors required rate of return. That's technically your investors required rate of return. Company proposes to price the issue in such a manner that it can yield 16% to the investor. Now, yield is not coupon, okay? Don't confuse coupon with yield. So, you cannot say people are expecting 15 and company is paying 16. That's not the logic. People are expecting 15, company is paying 9, 10 and 14. Company is paying 9, 10 and 14. But now company says, let people expect 15%, but I will price my issue in such a manner that people earn 16%. People earn 16%. It is not exceeding expectation of people. Don't confuse with that concept. People are expecting 15, company is paying 9, 10 and 14. Now ideally it will trade at discount. 9, 10 and 14 tells me that it is going to be at discount. On top of this, now company is saying people are expecting 15, let me give them 16%. Let me give them 16%. Whereas in reality what they are giving is 9, 10 and 14. So how will they give this 16%? By issuing it at a discount. By issuing this at a discount. So the concept is not people expecting 15 and company is giving 16 here. People are expecting 15, irrelevant number. Company is paying 9, 10, 14, relevant, and company wants to give 16 is relevant. So the discount rate in this question is 16%. The discount rate in this question is 16%. Another reason is they wanted to determine the issue price and they want to fix the issue price in such a manner that people earn 16%. People earn 16%. So we're going to do year cash flow PVF DCF. Discounting will be done at 16%. Discounting will be done at 16%. Now the same question can ask, determine the issue price of the debenture. Also determine the fair price of the debenture. Fair price is at 15%. Fair price is at 15%, but company says I want to give more return, so they may be issuing it at a slightly lower price. They may issue it at a slightly lower price. That's their wish. The company wants to do, because they are saying I want to price the issue in such a manner that it can give 16% return to the investor. I want to give 16% return. That's something company wants to do, so let's follow whatever they want to do. Any doubts on this? Any doubts on this? Let's start. Investors required rate of return. Investors required rate of return is 15%. Investors required rate of return is 15%. The company wants to price, the issue, in such a manner, that investors earn investors earn 16%. Investors earn 16%. This would be possible. This would be possible if we compute the issue price, with a discount rate of 16%. With a discount rate of 16%. Many investors would be buying the share because they believe whatever answer you're going to get finally, because people wanted 15, they are giving 16%, so share is going to be, the company is going to undervalue itself. They're going to undervalue the bond and sell. People will start buying it, the price will go up. So year cash flow, PVF, DCF, annuity may not help much in this, because the rate is different. Year cash flow, PVF at 16%, DCF, 10-year bond. I'm not doing the annuity tables. You can try even annuity, but I don't want to get into annuity tables because the amount is going to change. First 4 years is 9. 1 to 4 could have been an annuity. 1 to 4 could have been an annuity. 5 to 8 also could have been annuity. You can get an annuity factor for that in a slightly different manner. I don't want to do it. I'm just writing like this. Your wish, you want to write it like an annuity, you can do it. 1 to 4 is 9. Then this is 10. 14. Tell me the last year how much? 10 plus 14. 119. This is going to be at a huge discount because they are paying 9, 10, 14. And you want to, our investors required rate of return technically has now become 16 because that's the discount rate. That's the discount rate. We are calculating issue price and not the fair price. The fair price could be slightly more than this because for that discount rate should be 15%, because that is what investor wanted. They are saying give us 15% return. Any doubts on this? Can you proceed? Sure, take your time. Again, the calculation part, I may go a little faster, but you tell me to stop. Concept part will go slow, but calculation part, because I do it in Excel, it may go a little faster. 71.33 is the issue price. Fair price, I've not done the calculation. It would be some 75 or something, because if you do discounting at 15%, you'll get a slightly higher price. Company wants to underprice it so that people buy this debenture. The question has already given the number, no? No, so if you increase the issue price will increase, fair price will also increase, no? Because fair price is discounting at 15%. So anyway, you're going to underprice your security. That's not going to change the value. So because you change year to 125, let's assume, your issue price will go up now. Because it's a discounting of that, no? So you cannot do it through that route. Provided you do this 125 and you say you're not changing the issue price, then that's a different story. Because here you do, you'll change the issue price. Any doubts on this? 70s homework. Guys, homework question, I want you to complete it again and again. I'm repeating, please complete homework with the classes. This is a request which I'll keep giving in every class, but please do it, because things will get accumulated. You will find it difficult. Go through 71. Okay, a simple question again. A 9% 5-year bond, issue price is 90. Listen for some time. Year 0, 90. YTM is asked, so I'm just imagining the cash flow. Year 0 is 90. Year 5 is 105. Some adjustment can be there on this. Year 5 is 105. 1 to 5 is 9 rupees. This is normal YTM calculation. You use this and do the IRR, you will get a normal YTM. Here they are saying marginal income tax rate of 30%, capital gain tax rate of 10%. What is the post tax yield to maturity? What is the post tax yield to maturity? This 9 will go down by 30%. 9 will go down by 30% because you'll have to pay income tax on this 9. Of this 105 which you get on the last day, can you tell me what is the capital gain number without indexation? They have said 15 rupees is the capital gain because you paid 90. 15 rupees capital gain, 1 rupee 50 paise tax on that. 1 rupee 50 paise tax on that. For this cash flow, first I'll do a shortcut answer in calculator or present it in the notebook, and then try the IRR approach. So the only difference here is tax impact needs to be considered in the calculation. It is a 30% marginal income tax rate. For him, the YTM would be lower. If it is a 20% slab, YTM will go up. 10% slab, YTM will further go up. So the requirement is post tax yield to maturity. This can come in some other problem also. It can end up coming in some other problem also. They can ask you post tax YTM. Let's first write the cash flows. Shortcut, either we present it or do in calculator, and then we get to the IRR. So computation of YTM. have space for 8 columns. Computation of YTM, year cash flow, PVF, DCF, year cash flow, PVF and DCF, have space for extra 4 columns. Mostly we will do it in 6 columns, but sometimes I may need more also. Year 0, year 0, how much is the outflow? 90. Year 1 to 5, year 1 to 5, 9 into 1 minus tax rate, 9 into 1 minus tax rate, 9 into 1 minus tax rate, 6 rupees 30 paise, 9 into 1 minus tax rate, which is 6.30. Clear? At the end of year 5, 105 minus 105 minus 15 rupees capital gain into 10%. 15 rupees capital gain. How is 15 rupees? You are paying 90, redeeming it at 105. 90 is what we are paying. Redemption price is 105. Income tax will say there's a capital gain of 15 rupees. Capital gain of 15 rupees on which 10% tax needs to be paid. 103.5. Sorry, explain. So the your sale proceeds is 105, cost price 90, capital gain 15, capital gain is 15, tax on capital gain 1.5, net sale proceeds, net sale proceeds is 105 minus capital gain, 105 minus the capital gain tax which you need to pay, 105 minus the tax which you need to pay, 103.5. Any doubts on this? Clear? Before I fill this table, because I need a rate, so I'm going to do the shortcut answer now. I'm going to do the shortcut answer. You can present the shortcut answer here. YTM is equal to shortcut method. In exam not needed, in class also after few problems shortcut also I'll not be doing. I'll just do it in the calculator. YTM under shortcut method is equal to, what is the annual interest we are going to get after tax? Okay, 6.3 on redemption 103.5, not 105, 103.5, because we are doing all after tax calculation. 103.5 minus 90, 5 years, 103.5 plus 90 by 2. Let me know the answer. 6.3. This is a shortcut answer. 9 point. In exam, I don't expect you to present this. Again, I'm repeating, because the only concern is if at all you end up making an error in the calculation, unnecessarily presenting it. I don't see them deducting marks, but why to even present it when it's not needed? You can do this in the calculator. Any doubts on 9.3%? The numerator is I think 9 rupees, 6.3 plus 2.7. 9. Denominator is how much? 96.75. You end up getting 9.3%. Start with PVF at 9%. Start with 9%. Positive, negative will increase or reduce the rate. Do 9%. Let me know the NPV. This is the only problem where again I'm going to explain the IRR calculation. Formula for IRR explanation will come in capital budgeting. Depending on positive or negative, I'll let you know what needs to be done. What is the annuity factor for 9%? 3.8890. And fifth year factor, that is 0.650. You get a positive NPV. You get a positive, we are almost closer to zero. I'll increase this to 10%. I'll increase this to 10%. Or increase it to 11. I don't want a possibility of another positive NPV. Try it 11. Let's increase it to 11. Gap between the two rates should be as low as possible. A 2% gap is okay. A 2% gap is okay. Try 11%. Mostly you will get a negative NPV. Try 11. 10 also can give negative, but I'm not very sure. So let me try 11%. 11 high probability of a negative NPV. If the gap is lower, our answer would be more accurate. An acceptable gap is okay. 2-3% is fine. As you increase the gap, the accuracy will keep going down, because we use something called as interpolation, which assumes a linear relationship. Linear means exactly same percentage it will fall, which is not the reality. What is the annuity factor? 3.696. We got negative 5.34. So one positive, one negative. Will be in a position to now get to the IRR. 10% could have also given negative, but I'm not very sure. But yes, I think looking at the number, I can say 10% will also be negative only. 10% will be negative, which can give me a more accurate answer. But this gap is also fine. Any doubts on the two numbers? The only purpose of doing shortcut is what rate to start with. Otherwise, randomly you will start with some rate. You will get stuck. You don't know whether it's going to give positive, because this rate ensures we get a number closer to zero. In fact, 9.3 was the answer. IRR could be 9.5 or 9.4, somewhere closer only it is going to be. Let's do this. YTM is equal to L1 NPV at L1, NPV at L1 minus NPV at L2 into L2 minus L1. Formula, if you remember, okay, I only know the logic. I'm not spending time on the logic as of now. When I discuss this in capital budgeting, I'll spend some time there. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 is the lower rate, 9 plus 1.79, minus of minus will become plus, into 11 minus 9. You should get a number closer to 9.3. 9.5. 50. I'll tell you the exact IRR in a minute. If our gap we had reduced to 9 and 10, accuracy will improve. But I'll tell you the exact IRR which is going to be there. If you do a very high gap, our answer is going to be, if you do 9 and maybe 20%, you may get an IRR which is even 11-12%. There can be a huge gap also which can happen. So the accuracy will keep going down as you increase the gap. The exact IRR is 9.48. 9.48 is the exact IRR, which the point is, all of this in the practical world you're not going to do. This getting to the guess rate, all that is a calculation which is not needed. But an understanding of this concept will somewhere help you in appreciating the YTMs which are going to be there in the practical world. Because as YTM goes up, what happens? YTM goes down, what happens? How is the impact on the price? All that interrelationship you should be aware. But nobody is going to ask you to calculate YTM, because all this will be readily available. There are calculators which keep calculating them. No positive NPV, negative NPV concept and all is needed, because the accurate answer will automatically come here. So the exact answer is 9.48%. Our answer is more of an approximate answer. Any doubts in this? This question we have done post tax YTM. We have done post tax YTM. Any doubts? Clear? I think I'm kind of done. If there are doubts in this question, you can let me know. You will have to do shortcut only. No, what else will you do? No, no, practical will you do it in Excel. The shortcut analysis of what is the use? Okay, we'll end it then.